The Honest Money podcast is powered by 10x Investments, a licensed financial services provider. Consult with your financial advisor and let's 10x your future together.
Welcome to Honest Money. We're doing a talk about investments today, and this is going to be a little bit about psychology and your money and how you think about investing. And so get comfortable on the couch, sit back and listen to the conversation, and let's see if we can help you make some smart decisions around your investments and maybe avoid some not so smart decisions. And if you hear a little bit of frustration in my voice today, it's there. One of the things that bothers me about investing, and especially talking to investors, is we kind of stuck in this pattern as investors, and this is a global phenomenon. This is, whether you're 22 and starting out, or 62 or 82 and deep experience in the investment markets, this applies. So what happens is we'll watch our investments as investors, and especially what's happened in the last year or two. We start to form kind of a pattern in our brains to say that whatever happened last year is probably going to happen next year. Whatever's happened over the last 3 years, that's probably what's going to happen into the next 3 years. So we kind of form these patterns, and then especially when things have gone very well for a year, we think, okay, well, that's going to happen again. The last year was pumping, stock markets were up 20%. I'm expecting they'll go up 20% again this year. So I'm going to change my whole strategy to follow what happened last year. And especially with stock markets, it actually applies even more when we talk about specific sectors. So if we just talk about 2023 as an example, there were basically 7 shares that drove the world's stock markets. They actually have a name. They're called the Magnificent Seven, and those are primarily enormous tech companies, mostly based in the US. And they had a phenomenal year from a stock market performance point of view. Exactly why doesn't really matter. I think the point is that investors started to watch their share prices go up, those 7 companies, and so investors bought more and more and more of those shares. And these are enormous companies that just shot up in value. And so they did incredibly well. And if you look at the index in America, the top 500 shares in America is called the S&P 500. And you looked at the performance in 2023, you would say, well, gee, that was a phenomenal year. The markets did incredibly well. Kind of 18 to 25%, depending on which markets you looked at around the world. But when investors go and look at their statements, if let's say you own a global balanced unit trust or a global balanced ETF, your investment might not have done nearly as well. And then you're saying to yourself, well, hang on, why do I own this global balanced fund when actually the S&P did so well, and actually the NASDAQ did even better? Why don't I just sell everything I own and just buy the NASDAQ index to get more exposure to those Magnificent Seven? Because they did so well last year, I'm sure they're going to do incredibly well in 24 and 25. And so that's what investors do. And they do it repeatedly. They do it with tech. They do it with mining, if mining's going well. They do it in so many different sectors. And it's usually around shares more than anything else. And then the same applies when markets fall apart. So when things go really badly and stock markets go down for 3 or 4 years, investors start to say, you know what, stock markets are a lousy place to make money. Whenever I buy shares, they go down. I don't know if you've heard yourself say that, or friends or family. And then what investors do is they sell those shares, and they sell their stock markets. And whether it's individual shares or the index, they kind of do it as a pattern. They do it as a collective. And so they sell in bulk, and then the stock market goes down a bit more. And then all of a sudden things start to turn, because the professional investors and the kind of more experienced, savvy investors look around and they say, you know what, the stock market's offering incredible value. It's really cheap. And so the early investors start to buy. And they might be buying when the markets are still going down a bit, and it's a bit tough to be buying things when you're losing value, and even more tough when everyone else around you and the media is saying, gee, it's blood in the streets, sell shares, the stock market's a terrible place, but the savvy investors just keep buying. And so eventually they start to get rewarded because those cheap companies that they own are paying dividends, generating growing profits every single year. And so those investors start to make more and more money. And then share prices start to recover and they start to grow and they grow and they grow. And at some point, the stock market starts to perform really well. And after about 3 or 4 years of great performance, everyone else wakes up to it and goes, gee, stock market's pumping, maybe I should sell my cash, which has done nothing for me in the last 4 or 5 years, and put that into the stock market. And they usually do it when the stock market's really expensive. And then all of a sudden, the stock market goes south because the savvy investors start to say, there's no more value in the market. I think the market's really expensive. I'm going to cash out and put my money elsewhere. And then the market goes down. And so that pattern repeats itself over and over and over again. It's just really the kind of a destructive pattern of investor behavior. I feel frustrated because I can see it happen over and over again, and I can't get away or find a way to convince people who are in high quality businesses that are just cheap to stay invested. And equally, I can't seem to convince everybody that's chasing now, for example, the Magnificent Seven, chasing those returns to tell them to watch out. And I think that's why we kind of on Honest Money we preach diversification a lot, because I'm not saying you shouldn't own big tech companies. There's some fantastic businesses. I think if you just look at what Microsoft's done in the last 2 decades, a phenomenal company. Apple's a phenomenal company. And I just think that they are really high quality businesses. But I'm not going to go and take all of my money and put it in there. Why? Because those companies can halve in value. Their share prices might drop by 50%. So you could have $100,000 in there, and in a year it's worth $50,000. It hasn't changed the quality of the company. Still fantastic companies, but people have woken up to the fact that the share prices are just phenomenally expensive. So to me, diversification makes a huge amount of sense when you're not a crystal ball investor. And the truth is, no one's got a crystal ball that works all the time. In fact, no one's got a crystal ball that works any point in time. What might happen is you might be really lucky. You might flip your coin and you choose heads and the market goes up and you go, great, I'm a genius, I'm going to keep this coin. Then you flip the coin again next year and the market goes up again and you say, you see, my lucky coin, me and this coin, we're market geniuses. But there'll be a year when you flip the coin and the coin will say the market's going to go up, and that's the year it goes down, and suddenly you don't feel so clever. And so you throw your coin away and you try again. And my view is that's just not sensible. The sensible thing to do is have a broad exposure to a lot of different investment assets across a lot of different markets. In other words, don't put all your money in America, but equally don't put all your money in South Africa or in Taiwan or in China. Have a big global exposure. And the simplest way to do that is a world index. It literally owns the world. And if America's pumping and the tech shares are pumping, you'll get some of the benefit from that. But equally, you'll have exposure to Europe, where maybe Europe is really cheap and not pumping, but it might be the market that pumps next year. And then you'll be in there. But if you've got all your money in tech shares right now, you're going to miss out on maybe the potential recovery in Europe or the phenomenal recovery in India or something like that. I'm not sure. That's not a prediction. And then you equally will have the catastrophe when tech shares fall over in America. I'm not saying that's going to happen now, but just valuations count. When sectors and companies are phenomenally expensive, they can get more expensive. They can keep going up for a while, but always they correct. Always valuations start to weigh in on a company, and share prices turn to make those companies more valuable again. And the problem is we just don't know when. So if you own a global balanced portfolio now and it hasn't done as well as the tech shares, and your friends on the, whether you're mountain biking or golfing or buying, and someone's telling you about, how amazing their investments were last year, and they're up 25%, and you're only up 5%. perhaps just wonder whether that 25% is going to fall over, whether those people are going to see big losses in their portfolios in the months or years ahead, and your portfolio keeps growing at 10 or 12%. Who's the genius then? And I think, understand that the people are really vocal about how wonderfully they're doing with their investments. Those are exactly the same people that say absolutely nothing when they have a lousy year. So worrying about what everyone else is getting around you, that's called FOMO. It's a fantastic way to lose money. Just understand that. I'm going to repeat that. It's a fantastic way to lose money. What you need to do is build a strategy that suits you, have proper diversification, and then keep growing your money consistently over time. And don't worry about what everyone else is doing. The truth is that the loudest people probably have the least amount of money and the biggest amount of debt, and they want to feel good about themselves, so they brag about something. The wealthiest people out there are often, they call them the quiet millionaires. They've got very good investment portfolios, they're doing very well, and they feel no need to brag about it. And so you're not going to see those people on social media with their bling, outfits and cars and stuff. They're just there living their best lives and actually doing what everyone else wants to do. And so forget about what everyone else is doing and just stick to a strategy that works for you. And most importantly, don't get overexcited when one part of the market is absolutely booming and you don't have all your money in there. And don't get too depressed when a portion of your portfolio is going down. Diversification is good, and diversification means that some of your money will always be performing not as well as other parts of your money. That's okay. That's the whole point about investing, is it's slow and consistent growth over long periods of time. It's compounding little bits of gains year after year after year. And when you look back over 5 and 10 years, you will have a lot more money than those that have made 30% in 1 year and then lost 30% the next year. It takes phenomenal luck to be a wealthy investor when your portfolio is doing plus 30, minus 20, plus 20, minus 50, and you do that all the time. So chasing returns is just a great way to lose money and a horrible way to live. So I hope that helps. You can get off the couch now, and if you want to know more about this, there's a fantastic book called Same as Ever. I'll repeat that. The book's called Same as Ever by Morgan Housel, and he talks a lot about what doesn't change, how humans don't change, and how we can take advantage of human behavior as an investor to make money for ourselves. And I encourage you to read that book if you're getting tempted by chasing the FOMO investments of the moment.
The Stradivarius violin is considered to be the most emotive instrument in the world. That's why you'll often hear it in investment ads, adding drama and the utmost importance to their philosophies, or for the announcement of a fancy new fund manager. 10x investments don't need dramatic instruments to seem impressive. They let the results sing for themselves. So 10x your future without the drama. 10x is a licensed FSP.